So thank you so much for coming on, everybody. Great response to tonight's webinar. A lot of enthusiasm. I got a lot of emails, excited about it. And I wonder why. The topic is taxes. So taxes are due on what, June 15th or sometime in April? I don't know. What do you think, Chris? So it's coming up pretty fast, huh?
Oh man, we're counting down the days. We got 5 days. They gave us a couple extra days this year, April 18th, right? And we're going to use every one of them.
I don't know. Gene, I think you're probably circling that date and ready for that date to come and go, aren't you?
It might be nice, but no. No, what we're doing is great though.
I'm just curious. So, you can only do what you can do. I bet you get a lot of clients last minute that are doing taxes, and, maybe you can address some of that on the webinar. But if you get people last minute, are you doing a lot of extensions?
We are, yeah. We're telling a lot of people they're at that point, honestly. I had a guy call me today. Can I do my taxes now? No. But we'll file an extension.
Well, it was interesting. Don and I were talking today. There's tax planning versus tax preparation, and there's a big difference between the two of those. And so if you're just waiting till last minute to file your taxes and just get them done, that you're missing out on the tax game. And I'm sure you guys will discuss some of that in the webinar, but tax planning and tax preparation, big difference. And you don't want to be doing just tax preparation, guys. Make sure you're doing tax planning, right?
Yeah. And let me highlight, you also don't want us to do your tax return in one day. You want us taking a little time.
That means you're probably likely overpaying for things you didn't plan well for.
Yes, it's better to get that extension in. Give us a little time to make sure that you've got things worked out for you to write. Yeah.
So you're saying I shouldn't mail you overnight UPS my shoebox of receipts, huh?
Yeah, no, I don't think that'll be a good idea.
It's such an interesting thing. And really, I don't think a lot of people, if they're new to taxes, I know a lot of our students are pretty well versed. There's so many strategies that change every year. You guys know this, but our students are pretty well versed. It's just really funny to find novice people who have never really done anything with taxes, even very experienced real estate investors who have a lot of properties it's kind of an afterthought. And so it's really funny to us to see someone who finally gets it, from a tax planning perspective. Oh, I got to put some LLCs in place, got to file some different things, plan in advance, maybe some cost segregation, things like that they've never thought of, and they don't realize that's where the wealth game is won, is in taxes. Almost, that's reality, isn't it?
Yeah,
it's amazing. And I don't know that we'll get through this tonight, but Kendall, we went and audited our tax plans last year because, as you know, we don't just do prep, but we plan. That's kind of what we do with business owners. And I was actually shocked by the number, if I'm honest, because we have small business startups, just even pre-revenue, all the way up to businesses doing a few million in revenue. And on average, across the board, our plans identified $43,933 in tax savings, not deductions, actual tax savings if clients implemented the strategies. And so, to your point, the pool of potential money that's just sitting out there that people keep shoveling over to the government when they don't need to is astounding. That's literally millions and millions and millions of dollars from our clients alone. When you think about just business owners in general in this country, there's so much being paid that doesn't need to be paid.
Well, it really bugs me too, because a lot of people think, I don't know, it's political too, right? And a lot of people think, hey, I got to be paying as much tax as possible. If you're finding a way to weasel out of taxes, how dare you, and that's kind of the mentality for a lot of people. And that's not the case at all. Maybe you can address some of this, Gene, maybe you will, but I don't know. The tax code's not set up that way. There's most of it is how you can, reduce your taxes really legally. And that's what Congress has passed in the tax code. That's really what it's all about, honestly.
Yeah. And it is definitely designed to benefit business owners and investors. So investing is a good thing from a tax standpoint.
I like that. I wonder why that is. That's because you end up making more money and therefore long-term pay more tax. That's how I feel about it.
And fuel the economy. I mean, and we'll hit that tonight real quick, but listen, those that write the policy, they know that investment is what fuels the economy. They know it. And they want
small business is the biggest driver out there, isn't it? Absolutely. Yeah. Well, if you guys are good, I'm gonna, let's see, make sure we are still recording good. So what I'm gonna do, I'll get started, do a quick intro for you guys, and then we'll turn it over to you guys and we'll get rolling.
That's great. Thanks, Kendall.
Thank you. Okay, all right. Okay, let's make sure you can still see my screen all right. Looks like we're good to go. Welcome everybody to tonight's webinar, Tax Strategies Before You File. And hopefully a lot of you, this is not the case. You've been planning all along, but hey, a lot of you got till the 18th. That's right, the 18th, right, this year, guys?
The 18th if you don't extend, yep.
Okay, so hopefully all of you have been thinking about this for a while now. A lot of our students, I know that's the case for a lot of you, but if you haven't, well, it's good timing. We have Chris Brown and Gene Bott with us tonight to cover some of that. And we'll do a quick kind of rundown of what we have coming up here. We have a lot of webinars we do. As you know, this is part of a series that we do. You can see on our YouTube channel, we've got several past webinars we've archived there. And gosh, there's some wealth of information there, including, you'll see on there, and Chris and Gene know Kevin O'Leary well, which we were so honored to have Kevin O'Leary in the past on one of our webinars. And that was so fun because the guy's a guru, you know, he's a Shark Tank guru, just so much fun to have him on there. I was blown away. It was really interesting to me, just as caveat, was how Kevin O'Leary, Shark Tank, you know, TV star, whatever you want to call him, he's so savvy. He gets the game on taxes too. And that's amazing. Cool.
He's amazing. He's an amazing partner to have. It's incredible.
It's so cool. So we got an archive there of Kevin O'Leary. That was amazing. We appreciate that from Taxhive. And, you know, we have future webinars coming up. There's some great topics. You know, we try to cover, you know, everything from A to Z when it comes to your finances, and really asset protection, estate planning, taxes are our bread and butter, but there's some other things in there you can do to help build your wealth. And there's a lot of good things coming up. So stay tuned there. If you're not signed up, you should get an email from us shortly on some of the upcoming dates. And by the way, it's all archived to Protect Wealth Academy. Just do YouTube, search Protect Wealth Academy, subscribe, you can find us there. And we have some upcoming summits. This is our 3-day Asset Protection and Wealth Creation Summit. This is our premier event. I know we're biased. We've been doing this 20 plus years. I can't tell you enough. You can go and look at Google for yourself and Facebook yourself and see the reviews. They're real, genuine reviews. We literally have thousands in paper format, but now we're on Google and Facebook. Literally, I'm telling you, like I said, I'm biased, but it is the best out there. You won't find better on the topics of asset protection, estate planning, and taxes. You just won't. These are the best in the business. We do our best to find the people who are the right people to help you do better. It's a free event. Sign up April 24th, 26th, and June 12th through 14th. And you can live stream. It's on Zoom. You can do it from your couch, from your car, from your office. Please join us. We'd love to have you. Also wanted to mention some awesome different tax tips we have coming up. We kind of do this periodically. Always suggest look at Facebook. We're always posting new things. I'm sure Gene's always trying to stay on top of what the IRS is doing. A lot of these tax tips come directly from the IRS, and they are your advocate in so many ways. Believe it or not, there's some great things there, and sometimes they're not your advocate. So anyway, there's some good ways to look there. You can actually sign up for a lot of these and see them on Facebook. We suggest you like or subscribe, if you will, on Facebook. And before we get started, you guys may already do a disclaimer, Chris and Gene, but we always do a disclaimer. This is not specific legal, financial, or tax advice for you. Sometimes, of course, that if this applies to you, great, but you need to seek out competent legal advice for you. Don't take it as individual advice. So Chris Brown, CEO of Taxhive, and Gene Bott, CPA. It is now April 13th, and I'm sure Gene is in the heat of the battle right now, taking a break to join us on the webinar. I know it's amazing. I love having both of you on because Chris, your knowledge is amazing. And Gene, the detail you have in doing the taxes too, you'll see it right away, guys. These two know what they're talking about when it comes to taxes. So Chris, Gene, I'll turn it over to you guys. Thanks for being here. And if you want, I assume you want to leave questions till the end. Is that right?
Yeah. So what our thought is here, maybe if I can just give an overview, is what I want to do, what Gene and I talked about wanting to do here, is we wanted to share kind of a bunch of ideas to kind of get the juices flowing, to get things going with everybody here today on some tax strategies, things that you should consider implementing depending on where you sit, and just kind of get the juices going. And candidly, we're going to hit you with the fire hose, if that's okay. And what I would love is all along the way, throw questions into the Q&A box. And last time we were on here, there were so many questions. It was an impossibility to get to everybody, but we'll answer a bunch of the questions, and then we'll make sure that we put you in touch with somebody who can answer your question. If you answer a question that we can't get to, we'll make sure that everybody has a way to get your questions answered. But if it's all right, Kendall, we'd love to just hit everybody with a fire hose and then open it up to questions and unpack them as they go along, if that's okay.
Yeah, bring it on. I'm sure there's tons of questions. We'll try to do our best to get to them, but may not be able to. But again, you'll have a nice way to answer questions later on. Thank you so much, guys.
Help they need. Thanks, Kendall. Well,
thank you.
Let's jump in real quick. I wanted to just kind of set the tone a little bit to make sure we understand what we're working with, because I think this matters. I think as this matters, it's important to understand why things are the way they are. And Kendall alluded to this earlier. The tax code is written to incentivize investing in business ownership. And here's the reason why. 2/3 of all new jobs in this country are created by small business, and 40% of economic activity is attributed to the same group of small business owners. So regardless of what side of the aisle you sit on, the minute that you begin investing, the minute that you begin an activity with an intent to profit, the tax code completely changes. And it's just important to understand that really, truly, taxes aren't something that just are what they are and there's no way to impact it. Because of the way that things are designated, you and I have a real capacity to impact what we are or aren't going to pay. So I think it's just important, first and foremost, to realize that we do have control over what we pay. On the flip side, what's the IRS? They are a debt collection agency, the biggest, strongest, most powerful one that I'm aware of. Many of you have seen it in the news. They're going to hire 80,000 plus new agents with one purpose, and that's to make sure that you pay every penny you're supposed to. The great thing about the IRS, though, if you want to look at it that way, is they just want us to play by the rules. If we play by the rules, we're great. But we have to understand the rules. They're not going to raise their hand and say, hey, Gene, I think you overpaid this year. Why don't you go implement this strategy? But as long as we're playing by the rules, the IRS can be an ally. If we understand how to reduce the tax liability that we have, they're there to help. So quick story. Gene, you've heard this before, but I love basketball. And growing up in the 90s, Michael Jordan and Scottie Pippen dominated. 6 championships. They beat my Jazz a couple times. And I remember watching them play thinking anybody can win a championship with this team. And I gave Phil Jackson as the coach 0 credit. Well, there's this great documentary that came out called The Last Dance. If you haven't seen it, you need to go watch it. It's amazing. It chronicles their final season. And as I watched, I gained a whole new respect for Phil Jackson and his staff. Behind the scenes, Phil Jackson and his staff consumed hours of game film. They wanted to understand the opponent and their own team in as much detail as possible so they could create game plans to make sure that their team was in a position to win. They changed game plans based on the team they were playing, based on who they had in the lineup, based on what time of year it was. In the playoffs, they made critical corrections throughout the playoffs. During the game, Phil understood his team and the other team so well that he was able to strategically do things to put his team in a place to win. Because once the bell sounds, once the champion's been crowned, there's nothing anybody can do to change the outcome. Now, there's no doubt Michael, Scotty, Kerr, Rodman, whoever it is that you point to, they were the players on the court that had to take the shots. So what's my point in sharing all this when we're talking about taxes? I want to maybe point out three critical things. Number one, everybody on here, you're the player in your own world, and you have to take the shots. Simply counting on an accountant to magically do things that are going to save you money at tax time isn't going to cut it. I wish it would, but just candidly, you have to be engaged. You're the players in your own business. You've got to do things in order to save money. Now, this doesn't mean the taxes need to consume you, but a little bit of energy can save a lot of money. Lesson number two, you've got to make sure that you have the plan in place in order to execute on that plan. You need somebody who understands your strengths, your business's strengths, the opposition's strengths, so to speak, meaning the rules of the game, the IRS tax code. And you need to make sure that they give you the direction that you need so you know what shots to take, what defensive scheme to run, and what you need to do in order to really dramatically reduce your tax liability and save money. Number three, the final thought of the analogy is that right now is the time to save money for next year. Now, we're going to talk tonight about some things and a lot of things that are going to have the potential to impact your tax bill. There's a handful of them that right now could improve your tax bill from last year. But candidly, once the horn sounds, once the champion's been crowned, there's not a lot we can do. There's a lot more flexibility in the plan looking forward. We always talk about forward taxation, meaning right now, today, as strange as it sounds, as foreign as it sounds to many people, what you're doing today is impacting next year. So we want a plan in place now to implement between now and December so that next year we can save a lot of money on taxes. And again, there's some things that we can do to improve last year, but our options are limited, and we'll look at that. So what I want to jump into, and what Gene and I want to do, is we want to jump into some of these specific strategies. So I've asked Gene to take some time and real quick. I know Gene can go deep. He's got more knowledge in his pinky than I have in my entire brain. But we're going to let Gene real quick thumb through and push through a lot of tax strategy ideas to kind of plant the seed to help you understand the kind of depth and breadth of potential that's out there to save money in taxes. And as he goes through these things, I want you to pick up on if there's an area that you want some further clarification on, or you want us to go deeper on, throw it in the Q&A and we'll unpack that at the end as we jump through things here. So kind of agenda when we talk about planning, we want to look at entity optimization, deductions, loopholes, credits, retirement strategies, charitable contributions, health strategies, deductible loss strategies, deferral strategies, employee strategies. The list could go on and on. We're going to hit these high level, and then we'll come back and answer questions. So Gene, let's first off talk about entity optimization. You're a big proponent of making sure that you're positioned right. Give us a crash course on entity optimization.
Yeah, thanks for the tee up there. So when it comes to entity optimization, and I'm sorry, people, I am going to rush because I want to get to your questions. But when it comes to entity optimization, we have a lot of tax accounts out there that'll talk to you about just get into an S corporation right out the gate. Well, that's not always what you want. The S corporation is largely beneficial for those that are in $30,000 or more in net profit, but it's not always the case. And for those that are less than that, it's definitely not going to be the case. You're going to pay more to have that S corporation than you're going to save. But you also got to keep in mind there are some states that have different laws that change the way the S corporation works and how beneficial it is for you. So it really takes some digging to look at this and figure out what you want. Now we have on here sole proprietorship. I do want to highlight, we want you to be an LLC no matter what. So set up an LLC and then tax that as a sole proprietorship until the time comes right to make an S corporate election. Now you might want to be in a partnership as well. And that would be like if you're running real estate with some partners, you probably don't want to be in an S corporation. But how you structure this entity can honestly save you tens of thousands of dollars. sometimes even up into the hundreds of thousands of dollars range. For the general rule of thumb, if you're not in real estate, an S corporation is going to be right for you around $30,000 in net profit.
And I think one thing I would just point out here, Gene, and again, we're kind of crash coursing this, so we're not going real deep. The vast majority of the time, if you're owning real estate inside of an entity, you don't want it to be an S Corp. So we talk about S Corps tax savings. It's going to save you about 15.3%, I think is the number. But if you own real estate, don't put it in an S Corp. There are some real challenges there that, again, we could unpack more, but I just want to point that out so people with real estate don't run and change over to an S Corp.
Unless it's fix and flips, then let's have a further conversation.
Correct. So common deductions, Gene, there's all sorts of common things. And again, the list could go on and on and on. But what are some of the common things that people need to be aware of when trying to maximize just deductions that so often we don't see people take that they should?
Yeah, so these first three, most of you are probably pretty familiar with. That's the home office deduction, your mileage deduction, your meals and travel deduction. All three of those are pretty common. But what we see most often, though, that kind of throws us for a loop is there are a lot of people out there, accountants included, who are living with an 80s mentality where you're living in fear of the home office deduction. Please don't do that. The IRS is not hunting it. Just make sure you're claiming it right. Do it the right way. Be aware, though, that there comes a point in time when you will convert to an S corporation for most of you out there. And at that point in time, you cannot claim those and do it right unless you're doing the accountable plan. And that's where the accountable plan comes in. Captive insurance is a heavy hitter strategy out there for those of you that are making $300,000 or more in net profit. That's when we start exploring this captive insurance option. But deductions are just legal ways of reducing your tax bill through the tax code and what's allowed to you. Anything else you want me to dig a little bit more on?
No, I think there's so many out there. I think one of the things that I would just maybe plant in people's mind, and you've hit some of the key areas that we see: home office, mileage, meals, so on and so forth. Conceptually, this is what I would say. If you're spending $1, if there's an expense that helps you create $1 in return in your business, that's probably going to be tax deductible. Not always. There's things like entertainment that we could maybe try to justify aren't deductible anymore. But in general, if I'm spending $1 in the pursuit of something that's going to help me produce some type of return, that is typically something that we can claim as a deduction. Kind of moving into that, there's some loopholes and credits, different things here, Gene, that we want to make everybody aware of. A couple of my favorites that I love here, but just kind of crash course us on some of these things that are super powerful if they apply, that we should be aware of.
Yeah, so for those of you out there who are not aware, when we're talking about credits, we're talking about things that the Congress has written into the tax code to incentivize you to behave the way they want to by giving a credit for that behavior. Loopholes are things that are in the tax code simply because it's a massive tax code, and there's a rule somewhere that conflicts with a rule somewhere else that creates a loophole that we can legally exploit. And when I say legally exploit, let's talk about the Augusta Strategy for an example. The Augusta Strategy allows you to have a property that you rent for less than for 14 days or less. And if it's 14 days or less, the tax code actually has a place in there written about second homes, where it says if it's 14 days or less rental, then you don't have to report the income and it's not a rental property. So you can actually use this in your business to take advantage of some business deductions for some business purposes and get some pretty nice write-offs. Totally legal loophole that was not intended, but totally there, and the tax court has upheld it. The IRS lost fighting this, so it's totally legitimate. And then, of course, you have your credits like the solar credit, vehicle plug-in credit, both of them extended through the new bill that passed at the end of December, so that you can actually take advantage of setting up some renewable energy options for you and still get some really nice credits.
I'll just point out two things here to add. Augusta Strategy, it's Rule 280A. You may want to write that down. Typically, when we work with our clients, that strategy alone creates about a $20,000 deduction, just under $20,000 in deduction. Augusta Rule is one. Gene, if you want to weigh in here when we talk about things to do last year, if I actually used my home for my business, for board meetings, for marketing meetings. That's something that even if we didn't do appropriately throughout the year, if I actually held meetings at my home for my business, I could potentially go back and create the paper trail that I need to create that $20,000 deduction in hindsight, if I really held meetings. We can't make up meetings, but if you really held them, that's something you can apply in retrospect.
Totally correct. Unfortunately, most of us have spouses and most of us were having meetings, even if we weren't calling them meetings.
Retirement strategies. I mean, this is a broad area with so much potential for investors. Talk to us about retirement strategies.
Yeah, this is a huge benefit for us because the tax code definitely provides huge benefits for retirement strategies. And there are so many different ways to do it because there are so many different businesses out there and all of us are different. And because of that, there's been multiple different ways proposed and passed for you to put away money into a retirement account that fits you and your business a little bit better than maybe some others do. So there is a question here from Jen Man that actually asks, what is the best retirement plan for a small business with 5 employees? And unfortunately, the answer when we get there, we're going to give you a little bit more, but the answer is going to be, it depends on you and your circumstances. And we want to bring in a financial planner and a tax planner and get it worked out right. And one of the things we like to highlight here there are 2 things I really want to highlight. Number one, wealth building is a little bit more critical than tax planning. And what is best from a tax planning standpoint is not always best for you from a wealth planning standpoint. So for example, if you're wanting immediate tax savings, you might be looking at something like a cash balance plan that allows you to sink away a lot of money. But if you're looking at long-term tax savings, you might not want to do a traditional cash balance plan. You might want something more a Roth account that gives you longer tax savings and better growth in the long run. You just really want to make sure that you're working with a financial planner and a tax planner. They are both attacking it from different directions and they're both critical. The other thing that I really want to highlight slipped my mind. So, I remember. It's that please keep in mind that $1 of investments does not equate to $1 of tax savings. You're definitely, when you're using retirement strategies, your goal is to grow your wealth while doing it in a way that gives you good tax benefits.
And one thing, I'm going to add 2 things here, Gene. Just the number that you can set aside is significantly more than most people realize. Now, there's rules around your income and your contributions, employee versus employer contributions. But I think in 2023, the top limit has been raised to, I think it's $63,000 for a solo K or for a SEP. And that's per spouse if you both own the business. So you could potentially get well over $100,000 in deferred savings using some of these plans. Again, as part of a strategic overall approach. The second thing, Gene, and again, jump in and correct me if I'm wrong, but the new rules that have been passed are going to allow us here to potentially use this again as one of those hindsight strategies. It used to be in the past that I had to have a retirement plan set up before the end of the year, then I could fund it this year. So if I had it set up before 22 ended, I could fund it this year and take that deduction last year. They've expanded those rules a little bit. I can actually set it up this year. So even if you don't have this set up right yet, you could set it up this year. And again, there's some rules around who can contribute and what can be contributed. But now under the new rules, you could potentially set up a plan this year. And if you fund it before you file your taxes, you could claim it on last year's tax return. So this is one of those things, if you need to get some savings in your taxes, that could be applied in retrospect as well. Anything, Gene, you'd add to that before we jump into charitable contributions?
No, that's totally correct. Just keep in mind there are some restrictions on how you go about it. So make sure that if you're looking to do that, we have a deeper conversation about how, and also be aware that it expands some other things as well. Like you can do Roth accounts in just about any type of retirement account now, just about. So there's a lot of great stuff.
We don't always love the new rules, but that's one we love. Charitable contributions. Lots of confusion around this, Gene. Just help us understand and unpack charitable contributions.
Yeah, charitable contributions. There are multiple ways to take advantage of charitable contributions to reduce your tax bill. There are ways to get it to where you can do some charitable contributions and get some accelerated tax benefits, is what I like to call it, because you're putting in $1 and getting a $6 tax write-off, so to speak. There are ways to do it where your primary goal is not necessarily the bigger tax benefit, but it's to triple the amount of growth, amount of benefit available to various people. There's just multiple different ways to do charitable contributions in a way that allow you to accomplish other goals while you're at it. And we've highlighted the 5 primary categories here. We'd love to cover those in more depth, but just know we can definitely take advantage of your giving heart to get you some good tax benefits. We just need to discuss what fits you and your situation better.
And I just want to reemphasize, in case any of you didn't catch what Gene said, particularly for higher income earners, there are strategies that for every $1 I donate, I can get $4 or $5 or $6 in write-offs. So that sounds crazy, but just in reality, let's explain what that means. That means if I donated $50,000 using this strategy appropriately, I could create somewhere between $200,000 and $300,000 in deductions. So what that means, or what that equates to, is I actually get more tax savings than I donated. So I get to actually keep more money, and I get to donate that money to a charity instead of giving it to the IRS. Really neat strategies for those of you that are earning. I mean, it can work before this, but really, Gene, I see our team recommending this over about what, $250,000. Some income is about where you start. Is that right?
Some recent rules have changed, and that number may increase soon, but it has been $250,000. Yes.
All right, health strategies. Everybody wants to know, how do I write off my health insurance? What can I claim? What can't I claim?
So health insurance is one of the best ones out there because it goes in tax-free and comes out tax-free. And there are multiple ways to accomplish this. The self-employed health insurance is one that most people are relatively familiar with because it's really straightforward and simple, and you can just use it on your self-employment income. It cannot create a loss, but you can definitely use it to offset some profits. And basically what it is you take any expenses out of pocket and you write it off against your business income as an insurance, if you will. The HSA is another one that people tend to be familiar with, either the HSA or the FSA, but not many people are familiar with the HRA. And the HRA is actually designed to provide small business owners a way to provide health insurance benefits to employees without needing to necessarily go set up a health insurance plan. Basically, the idea is you provide employees with a compensation, and they go buy their own health insurance using this health reimbursement arrangement. And the awesome thing about it is, if you're familiar with the health savings account, it has a $7,000 cap. The health reimbursement arrangement actually has up to $25,000. So it gives you a whole lot better benefit. Now, it's a little bit trickier to take advantage of it as a business owner, but there are some ways to do it.
And again, we can make recommendations. We have groups that can help facilitate that. Deductible loss strategies.
So this is one, we want you to be aware that your primary goal should not be tax savings with this. If that's your primary goal, you're going to lose because you're going to be out of pocket more than what you're going to gain. Your goal is to position yourself well for future wealth growth in a way that gives you really good tax benefits. Now, the one exception is the SOP. The SOP is another strategy. It's a structured ownership program that you're basically buying into a partnership and you're getting some accelerated tax write-offs similar to what you'd get through some of those charitable contributions we're talking about. But otherwise, your goal here is to position yourself to get some growth through investments in a way that you're getting some good tax benefits. Now, when I say good tax benefits, what I mean by that is, if you look at the oil and gas investments, typically speaking, the money that you put into there, you're going to get tax write-offs over the next 2 to 3 years that equate about what you put into there. But you are going to be out of pocket more this year than what you put into it. But then the goal is that you now have an investment that is going to pay you out some growth over time and possibly change the way your taxes on that investment are assessed so that you're paying less in taxes as well.
I like to think of oil and gas as a good strategy if I don't like qualified retirement plans, or maybe my setup doesn't allow me to put as much money into a qualified retirement plan as I'd like. Oil and gas is, perhaps I see it, Gene, a good alternative. I'm getting something that can grow and make money while still getting at least some tax savings along the way.
Yeah. And tax loss harvesting is a good way to highlight what I'm meaning as well, in that you shouldn't just sell positions to sell positions and get tax benefit. You should sell them to buy something that's better and do it in a way that's giving you a good tax benefit.
All right, deferral strategies. Sorry, I'm trying to pick up the pace just a little bit so we can get to some questions. Deferral strategies here, Gene.
Yeah, so deferral strategies, all of these are based around the idea of pushing your tax bill out into a future period, giving you time to handle it and possibly reduce it, possibly even change the way that it is depreciated. Maybe even through 1031 exchanges, push it into a period where it gets a step up in basis because it passes to some heirs. But your goal in all of these is to reduce your tax bill today so that you have more time to handle it into the future, getting lower bills.
Employee strategies.
All these are, again, one where you are going to come out of pocket worse than where you started, but your idea is to provide benefits to your employees in a way that gives you good tax benefits as well. So you're not just giving them money, you're giving them money and saving yourself in taxes as well. But just know each of these strategies costs you money. So it needs to be used in a way that's smart and accomplishes another goal that you're trying to achieve at the same time.
I think one thing I'd point out here with some of these strategies, Gene, if I'm the only employee of the business, or me and my spouse, well, it's great. It's just us, right? But some of these, if I have multiple employees and I want to give it to me and my spouse as an employee, I've got to give it to all employees. This is where you find that balance. You know, if it's just me and my spouse, some of these, it's a real no-brainer because it's just us. Let's offer the benefit. Sometimes, man, if I've got 5 or 6 employees, it becomes, hey, is this worth it? I'm going to get some tax savings to incentivize me to give them something, but I'm going to make a happier, healthier work environment. And it's just kind of that balance of figuring out what the right move is.
Yeah, and there are some that they are not available for you as the owner.
Correct.
Just be aware of that.
So here's a quick recap of what we've covered. You know, typically when we do this, when we work through with clients, the first thing that we do before we even do taxes, this time of year, we're often doing extensions and taxes kind of ahead of time because it's the time of year. But typically what we'd like to do is actually put together tax plans that identify the actual specific tax savings that a client's going to get. What we want to offer for everybody for being here today is a free consultation with our relationship with Kendall and Don and Protect Wealth. We just want to contribute to entrepreneurship and investors. That's Kevin O'Leary's mandate to us as a partner. And so for everybody on here, we want to say, hey, if you've got everything pinned down and you couldn't save a penny more in taxes, great, keep doing what you're doing. But for the rest of you, we want to offer just a free 10 to 15 minute consultation to talk about where you're at and point you in the right direction. So we want to invite everybody to either scan this QR code, it'll take you right to our scheduling page, or you can go to protectwealth.com/Taxhive and schedule just a 10 to 15 minute call with a member of our team to talk about your specific situation. And we'll point you in the right direction and help you get on the path to saving money. Again, there's so much money out there. Over $43,000 is what we're seeing on average. We identify in our tax plans from business owners, entrepreneurs, investors just like you that are being overpaid in taxes that don't need to. We've given a crash course tonight, but like we said at the beginning, every situation is unique, and we want to be able to spend some individual time to talk through where you're at and what might be right for you, what might be the right approach for you. So we've opened up a number of appointments, and because of our relationship, absolutely free, no obligation, go schedule a conversation with a member of our team, protectwealth.com/Taxhive. Scan the QR code. If you're on your phone, you can take a screenshot of the QR code, then go into your photos and just simply touch it later if you need to take you there. But with that said, Gene, let's unpack some of these questions, if that's okay with you. Let's try to knock out some of these in the time that we have remaining. And for the rest of you, go schedule the conversation if we're not able to get to your question, or if you have more questions, go schedule the conversation. Let us point you in the right direction. But coming back to Jen's question, Gene, you mentioned it earlier. I've got 5 employees. What's the best retirement plan? I know the answer is it depends, but what are some of the things that we're taking into consideration when we're determining the right plan?
Yeah, so some of the things to keep in mind are, first and foremost, are you trying to limit the amount of income that, or amount that you have to pay them as well? Because there are some plans that allow for more flexibility on discrimination than some others. Or are you perfectly comfortable providing them with some benefits as well? That can have a huge impact on what you're talking about. Some of my favorite strategies that you should keep in mind when we're talking about those kind of plans would be the SEP plan is really good, possibly the 401k profit sharing or the cash balance plan, or maybe just look for something on your personal side if you really want to provide nothing to your employees. Be aware though that you are allowed more discrimination currently against part-time employees, but also be aware that that discrimination is set to have some further restrictions placed on it with this new bill that passed, where part-time employees will get more participation than they have in the past in future years.
Yeah. All right, Bob, let's pick your question up. This is a retirement withdrawal question. Can required minimum distributions withdrawn from a solo K be donated and classified as a qualified charitable deduction with no federal tax due? Or is the donation only considered a charitable gift, which can only be added by Schedule A? That was a lot there, Gene. Sorry if you have to read it again.
No, but it's a great question. I really like it. And he does specify self-directed, but Bob, just be aware that that doesn't really matter in the scenario we're talking about. You can do a required minimum distribution straight to a charity and have it count as a qualified charitable distribution and get no taxes due on that. It actually can be a double whammy because you get to count that as a charitable contribution and you don't have to pay the tax on actually cashing that out. But you have to be careful in the way you do it, because if you do it the wrong way, you still have to pay the tax on the cash out of it. It has to go from your retirement plan straight to the charity. You cannot take ownership of it at any point in time.
So I want to make sure I heard you right, Gene. If I do that the right way, it goes right from my account to the charity. I'm not paying the tax. Did I hear you say I'm also getting a tax deduction in the process?
Yep.
Great.
One of the very few places you can actually take a double benefit.
It's amazing. Great question, Bob. I hope everybody picked up on that. That's huge. It's a great thing. CK, I have a C Corp that I run on the side besides my full-time job. C Corp has losses for the past few years, and I wonder if it makes sense to convert to S Corp to offset my California state income tax. I have a high W-2 from my employer. Will this tax strategy help to offset my California income tax?
So CK, there is some possibility that that's going to work for you, but you need to be very careful in the way that you're approaching this, because there could be some limits on, first of all, how much of the losses you can use to offset it. But also when you're converting a C corporation to an S corporation, there are a couple things that could trigger an unexpected taxable event. And you could possibly even lose the losses that are sitting in that C corporation. So be very careful in going about this. Make sure you do it the right way and really check into making sure that the conversion will not lose those losses and that you won't trigger that unexpected tax event. Usually that tax event is if you're sitting on some appreciated property, and don't do it the right way.
Great question. Another C Corp one I'm going to slide in here. I'm a realtor and I'm a C Corp, but it seems like most agents are S Corps. My CPA says most CPAs don't understand C Corps, which is why most realtors are S Corps or LLCs. What's your take on me being a C Corp? So this is one, Gene, I know there are some circumstances where you will recommend a C Corp. You usually don't, but just help us understand what's going on here, because this is something we see a lot, and I think there's some confusion around it.
Yeah, so the first thing you need to keep in mind about a C corporation is a C corporation is entirely a separate legal entity. It's like you created a living, breathing beast out of your company. And so the money that belongs to that C corporation remains belonging to that C corporation unless you pay it out in either dividends or wages to you. And the C corporation does have to pay taxes on those wages as well. So you are creating a situation where for you personally to be able to use that money, you will create a taxable event that causes it to be taxed twice. And so the only way that it really makes sense is if you're able to use that C corporation to reduce your tax bill into lower tax brackets. And we're talking about high amounts of money before you're actually pulling that off. So I don't know who you're working with and why they're recommending this and what their logic is, but it sounds like they're probably somebody that's working with an outdated mindset that's behind the times. C corporations were a big deal, again, back in the early 70s, 80s. But the S corporation has pushed most of those to where they're not as beneficial. However, there are some exceptions in certain states where maybe you're hitting one of those very, very rare exceptions where it makes sense.
That's great.
But we do have one follow-up. We have lots of documented tax computations where we can show most people are paying more to have a C corporation than to not.
Yeah. And when I mean, that's some good general rules and guidelines, which I think is perfect. When we plan, one of the things that we do is we actually want to run the real numbers through the software and figure out where we're going to land. And it's something that we look at. And again, the vast majority of the time, we understand C Corps, we understand S Corps, the vast majority of the time, and S Corp ends up being the right move. Gene, we mentioned accountable plans. What is an accountable plan?
Yeah, so an accountable plan is a way that a corporation reimburses employees for expenses made on behalf of the corporation. So if all of your expenses are run through through a company credit card or checking account, you don't need to worry about it. However, most business owners out there at some point in time, they or one of their employees are going to make a purchase for the business through their personal account. And technically speaking, your corporation cannot claim that expense unless you have an accountable plan in place. So it's a simple document really, but it just outlines that you will have them turn in receipts and you will reimburse it quickly and it will be for business purposes.
And it can be real simple. You don't need to overthink it, right?
Yep.
Were meals 50% deductible in 2022?
No, in 2021 and 2022, there were some exceptions where meals purchased at a restaurant were 100% deductible due to some COVID laws put into place. But back in 2023 now, the regular rules are restricted. And the 50% is the simplified version of that. But it is a little bit more complex.
All right, I'm just going to fly through these. Sorry, I want to get through them all. Well, we're not going to get through them all, but I want to get through a bunch.
I'm trying to tame my answers.
No, you're great. You're great. Can you deduct a home office for an LLC taxed as a disregarded entity?
Yes. And I love your name, Gene. Great name.
Easy to remember.
Yep.
Can you use, this is a great question. We see this all the time. Can I use the Augusta rule if I'm claiming the home office already?
Yes, you can. Let me give just a little bit more context. There is nothing out there strictly saying you can, but there is also, in all the time that the Augusta rule has been used, there is not a single court case we can find where the IRS has fought that, and we're pretty confident because they know that they'll lose it, so they don't fight it.
And in regards to the Augusta rule, Jen wants some clarification on the 14 days. That spread throughout the year. Is that 14 days in a row? How do I need to clock these 14 days if it's up to 14 days?
It can be up to 14 days with those 14 days spread out or together, either one, whichever you want. However, keep in mind that's 14 days in a rolling 12-month period. So we like it to be spread out one per month. Usually we like to limit it to 12 because that makes it so you don't actually have to worry about that 14-day limit. But just know that it's 14 days in any 12-month period, not necessarily calendar year.
And so I think that last part's important, right? It's 14 days in any 12-month rolling period. So if I did 14 days in December and then 14 days in January, I'm in trouble.
Yep.
Right. And then just a little clarification, we got a lot of questions kind of surrounding the Augusta rule. So Gene, just help us understand, walk us through in a little more detail. What am I doing with the Augusta rule and how am I getting this significant deduction that's available to me?
So you can use the Augusta rule so long as you have any business related reason to use your home in the business. And then your business just rents the home for the purpose of that. And the one that we most commonly see is a board meeting minutes. And the S corporation is fantastic in that it requires board meetings. And it doesn't have to be people who are actually associated with the business. It can be you and your spouse, even if your spouse is doing nothing with the business, because you can have anybody on your board. But you just gather for a board meeting at your house, have the business pay you for the purpose of that, and just record some meetings and do it. Or you can have company events there or something along those lines. Just know there are some other rules you need to make sure you're obeying if you're doing those.
All right. Again, you know, we got so many great questions here. I know we're not going to be able to answer them all. I apologize. We want to invite all of you to go to protectwealth.com/Taxhive. I know everybody's busy and good intentions often get forgotten. So I'd invite you right now, before we run off and do anything else, take just a moment. It'll take you about 30 seconds. Go to protectwealth.com or scan the QR code and go right there and schedule that free consult. I mean, we've got so many questions. These are great. We love to be here, but we do need to run for the evening. But I would love to make sure that everybody gets direction that they need. So we want to have this free consultation, put you on with a member of our team, give you some direction, talk about where you're at, talk about how you can get to where you want to get to, and point you in the right direction. So everybody on here, our simple invitation is take a little action, go to protectwealth.com/Taxhive, schedule some time. We won't take a lot of your time, but we'll spend 10, 15 minutes with you and make sure we point you in the right direction.
Yeah, it's worth the time, guys. We really suggest it highly. That's why we bring on Taxhive, because clearly you can tell they know what they're doing. They know the answers in detail because they've been through they've been through every tax preparation strategy there is out there through all different kinds of businesses. And that's one of the things we really like about Taxhive is they have a lot of pros. If you're a real estate investor, a business owner or whatever, they have someone there that can help you. I did put that on the chat screen. So if you can, always, that makes it real easy. Click on that. It's in the chat. We've had a lot of great feedback, Chris and Gene, from your team. Had a lot of students that jumped on there, and we're super excited because you found some strategies that they hadn't thought of yet. There, every accountant, CPA, Gene, maybe a lot of them are very conservative and don't really want to stick their neck out. Like you said, they don't want to do home office even. That's old thinking. That's, of course, take it. It's in the tax code. If you have someone who's very conservative, you may like them, but they may not be up to snuff on what actually is happening right now in the tax code. Yeah.
And we will, along the way, we'll tell you what the risk is associated with any strategy we recommend. And we do not recommend strategies that are high risk.
Yeah, you're following the tax code. It's funny that, a lot of people don't want to follow it. It's in the tax code. Yep. You're not going out and just, let's hide some money over here. It doesn't work that way. It's not how, it's not what we do.
It's one of those things, we always use this term defensible. If it's defensible, why don't we take it? Then we're not going to make things up, right? But when we have the right documents, like even with the Augusta Rule 280A, and Gene will vouch for this, if somebody's documented it properly, if they get called out, it's literally a 5-minute response with the documentation and it goes away. And so anybody out there who says, well, don't use it because it's risky, it's not. If you're using things that aren't real, it becomes risky, right? If you're doing things that you really didn't do and you're claiming deductions you really don't deserve, that's the risk. But if it's defensible, a little bit of information real quickly resolves anything in the unlikely event that it gets raised to the surface. But to your point, it's all about that defensibility.
Yeah, everyone gets scared of it. It's I think that's the main thing out there. I can't deduct stuff, but you can. If you can defend it, then do it. I totally agree with you. That's we could agree with that. You're kind of wrapping up right now. You want to take a few more, then let's wrap up a little bit?
Yeah, let's take just a couple more if that's all right, Kendall, and then we'll let everybody go.
Please.
So I think this is a great question, Gene. I'm going to apologize. I'm not going to try to attempt your name. I'm going to butcher it if I do. But it's a question for people that are W-2 employees. So if an individual or both spouse and husbands are W-2 employees and they don't have any business or investments, what, if any, of these strategies might they be able to play if they're or apply if they're high income earners?
Yeah, let me just state that the bottom line is the tax code is written to benefit business owners and investors. And so if you want to take advantage of tax savings as a W-2 earner, your options are to get into business or start investing. Anything else is not going to cut it. But as a W-2 earner, investment strategies like retirement strategies, oil and gas strategies, those kind of things are going to be available to you. You can definitely use them. One of the fastest, easiest ones to get into include the retirement strategies, but there are high earners can get into some of these other ones as well. But you have to become an investor or a business owner to make tax planning work.
Yeah. I think our belief is everybody should at least have some type of a side hustle because of the benefits that come from it.
Yep.
SOP, we've got a number of questions. I'm kind of bouncing through here looking at things, Gene. SOP, we mentioned SOP. What is an SOP?
So an SOP it's a structured ownership program, and it's basically where you go in and you invest in a company that has some long-term losses. They're doing some higher, riskier strategies, if you will, but they're doing it in a way that gives you some accelerated tax write-offs coupled with some potential investment growth. And there's a lot more we can say about that. It's actually one of the favorite strategies for those that are high income earners that we can talk about. But there are some huge benefits that come from it. But just know you're doing some investment in what's really riskier strategies, not normal strategies.
I think this is an important one because we've just seen this cause so many issues. So it may not apply to everybody, but those that it does apply to, it's a big deal. And the question is, when you said if you own rental real estate, you don't recommend an S Corp, why is that?
Yeah, the funny thing is it's not a big deal right now, but it's going to become a huge deal down the road because the assets you own in that S corporation are going to appreciate in value. And if they're owned in the S corporation, then there are only two ways that you can really accomplish getting it back out of the S corporation. One is you die and it passes to your heirs. And at that point in time, the thing that's really unfortunate about it is that your heirs will get a step up in basis in assets you own, but that asset isn't owned by you. It's owned by your S corporation. So it doesn't get a step up in basis. So you lost what is usually the biggest benefit you gain down the road from an S corporation. The other one is to sell it and pay the capital gains tax on it.
Another C Corp question, are capital contributions to a C Corp by two members taxed when the contributions are taken out at a later date?
Run that one by me again, sorry.
If I contribute to a C Corp, so two members contribute to a C Corp, are those contributions taxed if they're taken out at a later date?
No, but growth on them is. Let's use good English here. Sorry, everyone.
If you are a realtor and you have an S Corp, what happens to the rule that you must have payroll in an S Corp?
If you're a realtor and you have an S Corp, is that the question?
Yep. So you're a realtor, you have an S Corp. You know, I think my assumption, and I might be a little off here, is I'm getting big commission checks sporadically, but it's telling me I need to be on payroll. How do I navigate that?
Yeah, so usually what happens with realtors is you're getting the money from your commissions in your own name, but then you're running that through your business bank account so that it's going straight in there, not to you personally, but it's going straight into your business bank account, so it's the business's income. And then you personally, to meet the rules about the reasonable compensation, have to pay yourself an actual W-2 into your personal account from that, a reasonable amount.
All right, let's take one more, Gene. And I'm going to pick this one because, again, we see this a lot. If I'm an LLC taxed as an S Corp, do I have to pay myself if the LLC had zero income in 22?
No, please do not pay yourself. There are a couple states that actually give you a wee bit of a benefit for losses like that, but it's not worth it. Don't pay yourself. There's no way that's going to tell you a reasonable salary includes creating the loss.
And I think one of the things, maybe, Gene, just to unpack for a second on this S Corp, we see people run and become an S Corp because they hear about these tax advantages. Our recommendation typically is set up an LLC, get an EIN. Don't take the S Corp election until you're making $30,000 in net profit. Again, that's a general rule. we see people, because they hear about the benefits of the S Corp, run and get into an S Corp right out of the gates, which creates some additional expenses for them. Typically, we're not going to want an S Corp until we're making 30,000 in profit. So here's my question though, Gene. Let's say I got into an S Corp and I'm not making $30,000 in profit. Should I unwind that, or should I not? Should I hold off? Because I know there's going to be some push and pull here depending on what's going to happen in the next year or two with my business. What would you recommend I do?
Vast majority of the time, you do not want to remove that S corporate election. First of all, it's hard to remove an S corporate election. It really is. It's very hard. But second, once you do it, you have 5 years before you can be an S corporation again. And it's almost, there are exceptions to that, but it's almost impossible to get those exceptions to pass IRS muster, because you actually have to write a letter to get it. So unless you are confident that you're not going to be above that $30,000 again for the next 5 years, don't do it. Just stay an S corporation. It's better to pay those extra costs now. Just so you know, most of the time you're actually getting tax savings by being that S corporation, those lower amounts. It's just that you're paying higher costs more than what you're getting in savings. So that's one of those areas where it's the tax savings are there, but it doesn't make sense from an actual cash flow standpoint.
So if you know you're not going to be over that 30K, perhaps go ahead and back off. But if you're like most business owners and you're working towards making money and that 30K is around the corner, don't unwind that, or you're going to hurt yourself.
Yep.
Great time with you, Kendall. Thanks so much for bringing us on. I hope everybody has gone to protectwealth.com/Taxhive, and I hope you put my team to work. I hope you spend some time with them. We'd love to chat and see what we can do to help you. Maybe one last thing, if I might share a selfless plug, if that's okay, Kendall. We do these and we're happy to do them. We love entrepreneurs. If you got some value out of this, we would love it if you went to taxhivereviews.com or just scan this QR code and left us a review on Trustpilot and Google, gave us a 5-star, mentioned Gene, his team, Taxhive, that we give great advice, that you appreciate what we do for business owners, anything like that. If any of you feel so compelled that you got something out of this, a review for us is like gold. The way that things work, it's only screamers that go online and say things, and so we have to shamelessly plug it. But if any of you would go to taxhivereviews.com and just in 30 seconds leave a review on Trustpilot and Google, that would be greatly appreciated. Your 5-star reviews are much appreciated.
It goes a long way, guys. We really appreciate it. Seriously, Chris, Gene, thank you so much for your time. I know, especially right now, your time is extremely precious. So we really, really do appreciate it. Guys, we really like Taxhive. That's why we bring them on. They've got a great team. Definitely go to that link. We have found, and you can tell, listen to Chris, listen to Gene. Can you tell they're in the trenches right now doing taxes? It's a lot different speaking to someone. This is not theory. This is actually rubber hitting the road for you. And it's really different speaking to someone who knows what they're doing. And Taxhive, their team really do know what they're doing. They can help you guys right now get things done and really figure things out. It's, all the way down the road. Tax plan, tax plan. Don't just file taxes, guys. Tax plan. That's a great consultation that won't cost you anything but, what is it, a few minutes time, Chris, Gene?
Yeah, I'd say 15 minutes, right? Schedule 15 minutes. Give us 15 minutes.
It could be worth thousands of dollars to you, and typically is. So worth your time. Chris, Gene, thank you so much for time. We appreciate it. Gene, are you excited to get back to taxes? Looks like you're ready to dig in right now, huh?
I'm having a good time. That's great.
Thanks for taking some time off, guys. We really do.
Kendall, thanks so much. We love you. We love your entire community. Your clients are just amazing. We love spending time with all of them. So thanks for inviting us on, and we just appreciate you. So thanks for giving us some time tonight.
We appreciate you guys. Thank you so much for time.
Take care.
I'll see you.
Take care.